Now, can the rest of the tech trade catch up with the chip rally? Whew, long way to go. My next guest thinks a catch down is more likely. Joining me now is Jonathan Krinsky, BTIG Chief Market Technician. Why a catch down? I mean, software certainly has just a little bounce would go a long way.
Hey, John. So, yeah, I think the conversation to this point has been, how extreme the move in tech AI semis have been. But I think the conversation really needs to be shifting on, not only when will that rally exhaust itself, but why can't the rest of the market do anything as AI has been moving up? And, to put a couple statistics around this, the S&P as of today is 8% above its 50-day moving average, yet there's only 49% of S&P 500 components above their own 50-day moving averages. That is the fewest number of stocks above the 50-day with the S&P that far above its 50-day in history, back 30 years of data that we have. The next closest period you have to go to the late 90s where you had about 60%. And so, there's a lot of stocks that are really not participating. And, there's a difference between when tech's leading and everything's moving up and tech's just moving up at a faster pace, and when semis are doing what they're doing and the average stock is actually moving sideways or lower. Another stat here, the S&P hit a 52-week high on Friday. Actually, that's a 52-week high today, and 8% of the actual S&P names are at a 52-week low. That ties the all-time record in late 1999. So again, it's not just that names aren't participating, they're actually moving lower at this point.
Yes, and which is a situation that would seem to cry out for diversification, except that if you had done that earlier, maybe in too extreme a way, you're feeling dumb right now because, look at how Microsoft and Amazon and Google did during earnings. Look at how concentrated this move higher is, as you were just saying. So as an investor trying to be disciplined, what are the charts telling you? How do you do it?
It's a good question. I mean, again, if you look at of the 11 S&P 500 sectors, the only sectors, to exceed their spring high of late have been technology, of course, REITs, which are a very small part of the market, and energy, which kind of has that inverse correlation to the market. So, there's different pockets you can kind of try to get a little cute with, but the reality is the factor trading going on right now is so extreme that it's just very difficult to get out of the either tech AI or non-tech AI. And if it's not tech AI, it's really not working. And I think we've gone long enough. We're now several weeks into this new all-time high for the S&P 500, and the equal weight S&P 500 still can't make a new high. So I think the reality is we're kind of in the later innings of the semi-AI trade, and we're likely to see a swift reversion lower. And then we'll see. I think, I don't think the other names necessarily have to go down a lot following that, but I don't think you're necessarily going to get a lot of upside as we see the unwind happen.
History any help? Is there any period these charts remind you of?
Well, again, there's a lot of analogies to the late 90s, of course. And I think from a pure price perspective that you have to at least appreciate, some of these. We did a note last week looking at the top 10 performing NASDAQ 100 names, and the average move over the last year has actually exceeded the average move of the top 10 names into both the end of 1999 and the all-time high in March of 2000. So, you certainly have,
Jonathan,
you have that setup.
Part of what's different, right, is that right now it's companies, huge companies like your OpenAIs, Anthropics, that are still private, that are driving a lot of the animal spirits in the market, it seems. Whereas, back in the day, it was public companies with crazy valuations back in the late 90s, maybe a little bit into 2000, that were driving that. Is that functionally any different, or because the companies that are moving so much higher have real revenue and earnings, or does the fact that it's startups, private companies driving that still make the public markets that much more exposed?
No, I think that's a good point. Look, markets are never exactly the same over any two periods. I think what we've been saying is that given that, the fundamental backdrop is arguably better now, that likely means just on the tail end of this, it's not going to be anything like we saw then, right? I mean, the NASDAQ and the semiconductor index from 2000 to 2003 went down 85, 90%. So I don't think we're looking at anything like that. But, just for perspective, just to get back to the 50-day moving average, for instance, on the stocks, you're looking at a 25% drawdown. So I think that's a very realistic possibility, even if the fundamentals are still quite strong here.